Hello friends, how are you? I hope all of you are doing really good. So welcome to Economics for Finance Excellency batch, and in this particular video we are going to start with our new chapter, that is chapter number 7 on money demand. Very interesting topic now related to money, right? Obviously sir, whenever this word money comes, it automatically becomes very interesting, isn't it? So can you imagine a life without money? Absolutely without money, right? You have to live in a particular world where there is no money, sir. It's very hard to imagine, isn't it? Because wherever we go, if we need to buy something, if we need to sell something, there is only one medium of exchange, that is money, isn't it? So it's very hard to believe a life where there is no money. So that is what we are going to study in this chapter, that how important that money is, what is going to be the money demand. Then we will study about money supply, right? So all these things we'll be studying in this particular chapter now, right? In this particular unit, as per the ICAI module, there is a unit, and that unit is divided further into chapters. So this is chapter number 7 overall, that is money demand. From examination point of view, again, very important chapter. Why it is important, sir? Mainly because there are theories which we will be studying, right? Theories of money demand. Those are very important from examination point of view. Clear? So these theories we will be studying. Theories will not be studying in this particular lecture. We'll start in the next lecture with the theories. In this, we are going to cover all the basics, that what is money. Basically, we need to understand what is the money, what is the role of money, what are the functions of money, characteristics of money, what is demand for money. So all these things we are going to study in this particular lecture. Then we will start with, in the next lecture, we'll start with the theories of money demand, right? That the QTM theory is there, Cambridge theory is there, neoclassical or the Cambridge theory, right? Okay, let's start with money. So the first thing is the meaning of money. What is money basically? Money plays a significant role in every economic transaction, right? So we have already discussed about what is an economic transaction, sir, where there is exchange of goods and services, and there is exchange of money for those goods and services, right? If you are giving a gift to someone, that is not an economic transaction. Economic transaction is something which has a value, right? That is an economic transaction. So money has the general purchasing power. That means if you go to the market, you want to buy something, you can buy with the money. So that is the general purchasing power, and is easily acceptable in the settlement of every economic transaction. Obviously, if you have to settle, if you buy the things from someone and you have to settle that transaction, you can pay in the money easily. Anything that would act as a medium of exchange is not necessarily money. Now, this is important. You and your sister, you exchange your phones, right? It is a medium of exchange now. You are going to exchange your phones. You are going to give your phone to your sister and you are going to get the sister's phone. This is what? This is exchange. But is this money, or is this money involved somewhere? No, sir. So he says every medium of exchange is not necessarily it is to be money. In the earlier times, there used to be barter system, right? So at that time, there was no money involved, but that was a medium of exchange. One person exchanged his goods with the another person's goods, right? But no money was involved in it. So it is not necessarily money. Money provides a convenient means. One second. So what he is saying, he says the money provides a convenient means to access the goods and services, right? So it is quite convenient with the money that we are able to buy the goods and services. There is no specific definition of money. General meaning, the money refer to all the assets which are commonly used and accepted as a means of payment or as a medium of exchange or of transferring the purchasing power. How transferring the purchasing power, sir? You buy goods from someone, you pay him, right? You pay 10,000 to another person. Now that another person has 10,000 rupees in hand, which he or she can use for buying. So you have transferred the purchasing power. Clear? So any asset which is commonly used or accepted as a means of payment or as a means of exchange. Okay. After that, he says for policy purposes, the money is set of liquid financial assets, the variation in the stock of which will have impact on the aggregate economic activity, right? In the form of cash, the liquid asset, right? Which can be used for the various economic transactions, and how it can impact the aggregate economic activity, sir? If you have the less of liquid assets, if you have less of money, then obviously the demand will be less. Demand will be less, the prices will come down, and the recession will be there, and vice versa. After that, he says, as a statistic concept, the money could include the certain liquid liabilities of a particular set of financial intermediaries or other issuers. Right? So if you are a financial institution, then there can be some liquid liabilities. You have to pay money to someone, like the insurance companies have to pay, for the bills. Medical insurance companies have to pay the bills. So all those things, that for that also, what is required? Money is required. Clear? Now, functions of money. What is the various functions of money? What is the role of money basically in an economy? Medium of exchange. The money acts as a convenient medium of exchange and can be used directly, instantly, conveniently, and without any cost or restrictions to make the payment, right? So there is no cost involved. You go to the market, you buy a good worth 10,000, you will pay 10,000, right? You can identify the value of anything through money. That is what is given in the second point. That is the common measure of value. It is convenient. One second. So what is common measure of value? It is convenient to measure the price of all the commodities in terms of a single unit rather than record the relative price of every good in the terms of every other good, right? For example, if you go to the market to sell rice, right? Now, if money is not involved in the process, then how can you identify that what you will need in return for the rice? Right? It should be of almost the equal value only, then you will be at the benefit, right? Or let's say you go to the market, you sell your car and get rice in return. Is it the equivalent value? You go to the market and sell your car, and in return of the car you buy rice, you get rice. So is it so easy to identify the value without money? No, sir, it is not easy. That is why saying that with money it becomes easy to identify the value of anything which we can buy or sell in the market. After that, comparability. Goods and services which are otherwise not comparable are made comparable through expressing the worth of each in the terms of money, right? So without money, it is very difficult to compare the items. Like I told you, that car and rice, right? You won't be able to compare that you go to the market, you sell your car, and the car dealer says, I'll give you the rice, it's of equivalent value. Now without money, you won't be able to identify whether he is right or not, right? You will say, okay, whatever you are saying. Satisfaction of wants. The money does not have any inherent power to directly satisfy the human wants. Obviously, sir, if you are hungry, you cannot eat money as such, right? You will go to the market, you will buy food using that money and satisfy your want, right? So that is what he's saying. The money does not have any inherent power to satisfy. You cannot eat money and fill your stomach, right? So what money can do is, by acting as a medium of exchange, the money enables us to purchase the goods and services to satisfy our wants. If we are hungry, we can go to the market, buy some burger, buy some chips, and satisfy our hunger. Clear? Advantage over the barter system. Now, what happened in the barter system, sir? Barter system, let's say you want to sell rice and in return you want cloth, right? What was the major problem in that? The major problem was you need to find out a person who is in need of the rice and who has the cloth that you want, right? This is known as double coincidence of wants, that whatever you want to sell, the other person exactly wants that, and what the other person wants to sell, you exactly want that. This is known as double coincidence of wants. Clear? So barter system assumes the double coincidence of wants. With the introduction of money, the single barter transaction is split into two separate transactions of sale and purchase, thereby eliminating the need for double coincidence of wants. So this was one of the major drawbacks of the barter system, which has been reduced or eliminated with the help of money, that now we don't need to wait for another person having the goods that we want. We can simply go pay money and buy the goods. As simple as that. Clear? Right, sir. Okay, after that, store of value. Store of value is people hold a part of their wealth in the form of cash for the future spending. See, the future is quite uncertain, right? We always need to keep some money for any future contingencies. Any emergency can arise in the future. So we need to keep money. We need to store money, right, for the future. That is why it is known as store of value. You can store some money, you can store some value which you can spend in the future. Thus, money acts as a temporary abode of purchasing power. Money also, abode means the store. That in future, if you need to purchase something, you can use that money. For the time being, you can store that money. The money also functions as a permanent store of value as it has the perfect liquidity and commands reversibility. Reversibility means you can convert the money into asset, or you can spend that money on buying anything, right? Or you can sell anything and convert it into money. That is known as commands reversibility. And perfect liquidity means it is a liquid asset. You can go to the market, you can buy anything with the money, right? It's perfectly liquid. So these are some of the functions of money: medium of exchange, common measure of value, comparability, satisfaction of wants, advantage over the barter system, and the store of value. Now it says, what are the general characteristics of money, right? General acceptability: anything which is used as money must be easily acceptable by all, right? So money is one thing. When we are talking about the exchange of goods and services, the money is the only one thing that is easily acceptable by all. Now you go to the market, you want to sell your car, right? And that person says, I will not pay you money, I'll give you the equivalent amount of rice. Will this be acceptable to you? Obviously no. You will say, no, I don't want rice, give me money, and whatever I want to buy with that money, I can buy it, right? So it is the general acceptability. Durability: the money should not get spoiled or destroyed easily. Obviously you cannot easily destroy the notes and coins. Recognizability: the money should be easily recognizable and distinguishable. That is why the different color notes, different size of the notes are given in the economy. 10 rupees, 20 rupees, 50, 100, 200, 500, 2000. Every note has a unique feature, every note has a unique color, right? So that you can easily distinguish which denomination it is. Difficult to counterfeit: the money should not be easily reproducible by people. Sir, is it so easy to reproduce the money? Yes sir, we can put it in the photocopier machine and we can do the photocopy of it. No sir, it is not easy, right? Because there are all the elements, special elements which are printed on the special machines. You cannot do this, right? So this is known as difficult to counterfeit, difficult to copy. Scarcity: the money should be relatively scarce but should have the elasticity of supply. It should be scarce. Why it should be scarcer? Otherwise, if people have unlimited money, they will keep on spending the money recklessly, right? And what will happen? Then in that case, the economy will go into the inflation mode. But there should be a balance. According to the supply, this money should be elastic, right? If there is a supply of goods and services, there should be so much money that the demand is satisfied and the people are able to consume that what is being supplied, because that will be beneficial for both the producers and the consumers, right? So that much money should be there, but it should not be unlimited. Then portability: the money should be easy to carry from one place to another. Obviously, sir, the money should be easy to carry from one place to another. Uniformity: the money of a particular denomination must be identical in all its features, right? If the currency note of 2000 is there, then it has to be similar. It has to be identical in all respects. It is not like that one note will be having the pink color, another note will be having the blue color, another note will be having the green color. So it is not possible, right? So one denomination, one feature. Then stability of the value: the value of money should not be volatile and must be stable over the time, right? So if you have a 2000 rupee note, it will be worth 2000 in the future also. So it has to be a stable, right? It is not like today it is a 2000 note, tomorrow it will become a 200 note. No sir. Divisibility: the money should be easily divisible into smaller denominations, right? So it should be easily divisible into smaller denominations. We can have a 10 rupee note, 20 rupee note, 50, 100, 500, right? 200 and 2000. So it is divisible into smaller denominations, so we can spend accordingly. So this was all about money. This was all about money, the various functions of money, the general characteristics of money, right? Then comes the demand for money. Then comes the demand for money. Now, if you want to buy something from the market, right, what will you do? Obviously, you will demand money from your parents, right? Now, your parents are working, your parents will demand money from their employer. Now, what will the employer do? Employer will demand money from the government, right? From his clients. So this is a circle. Everybody wants money. Everybody is demanding the money. Why? For the transactions, because we want to buy something or we want to save money for the future, right? So there are various motives, but we demand money. So what is demand for money? He says, demand for money is the people's desire to hold money, and this demand is derived demand. Derived demands means derived from some needs, from some wants, right? So it is a derived demand. Otherwise, if you don't want anything in the life, if you don't want anything in the life, you say, I'm really satisfied, I'll just sit down in the corner of one corner and I don't want anything, then will you demand money? No. Why will you demand money? You don't need anything actually in the life, right? So you just want to be a saint and you say, I don't want anything in the life, I will just sit back, relax, and everything God will look after. Then in that case, do you want the money? No, sir. Will you demand money? No, sir. Right? So it is derived demand when we are demanding money for some reason. For some reason. So money is actually demanded for its liquidity and the ability to store value. Liquidity, why? Because money is so liquid that we can go to the market, spend that money and buy whatever we want to. And at the same time, ability to store value means that we can store that money for the future usage. Demand for money reflect the decision about how much of the individual's wealth is held as money. Now try to understand one thing, sir. Let's say there is an individual. What I want to explain here is, let's say there is an individual who is Mr. A, right, sir, right? So he's getting a salary. He's getting a salary of, let's say, 50,000. Now, out of this 50,000, what he is doing is 25,000 rupees he is investing in the market. He is investing in shares, let's say, right? And the remaining 25,000 he brings home as cash, brings as cash, right? Now, how much he can spend? Obviously, sir, he can spend only, how much he can spend? Sir, he can spend this 25,000 rupees, right? This is what. Now, why has he kept this 25,000 rupees as cash? Because he knows that there will be expenditure for running the home, right? So this is the value that he wants to hold as the money. Rest of the value is invested in the shares. This is not money now, right? This is not liquid. Now this is your liquid money. So this shows, right? This is the demand for money. This is demand for money. That is, demand for money shows that how much the part of the total wealth the individual wants to hold as the money, and the remaining part obviously will not be held as a liquid money. This is what is meant by this, right? Although money gives little or no return, unlike the other assets. What does it mean, sir? Now, if you are having 25,000 rupees cash in your pocket, will it give any return, any interest or anything? No, sir. These shares will give you dividend, but will money give you anything which is lying in the pocket? No, sir. Right? The money is not going to give you anything, isn't it? Right. But still, economic agents hold money. This is because it is most liquid and convenient way to accomplish their daily task. But still we say that we need money for our day-to-day transactions. Demand for money plays the significant role in determination of economy's interest, prices and the income. How, sir? if the people have lots and lots of money, then what will happen? They will obviously be spending more. Now, if they will be spending more, the prices will be up, the income of the economy is up, right? And as such, now the government, if the government tries to control this, the government will increase the interest rates on the loans, right? So this is how the demand for money plays a significant role in determination of economy's interest, prices, and the income. Variables which influence the demand for money are income, the direct relation with income. More the income, more will be the demand for money, right? More will be our expenditure and more will be the demand for money. Direct relation with the money demand, that is, higher the income levels, higher the demand for money. General price level, direct relation with the money demand, that is, higher the price levels, higher should be the holding of money. Obviously, sir, if the prices of the commodities in the market are higher, you will need more money to buy those products, right? Even the basic product, let's say flour is there, sugar is there, right? So if the prices of these products have increased, your money demand will also increase because you will need more money to buy these products now, right? After that, the rate of interest, inverse relationship with the money demand, that is, higher the interest rate, higher would be the opportunity cost of holding. Now, what does it mean by interest rate? Interest rate means now you are holding this 25,000 rupees in cash. What you could have done alternatively, you could have deposited this money. You could have deposited this money where? In the bank. And by depositing it in the bank, you could have earned interest on that, right? You could have earned interest on that. Now he says if this interest rate is higher, if interest rate is quite higher, then why will people want to hold money? There is inverse relationship then. Higher the interest, lower will be the demand for money. That means lower will be the people's intention to hold money as a liquid asset. The people will be willing to deposit that money in the bank because of the higher interest rate. And if the interest rates are quite low, then people will say it's better to hold as a instantly as a money. So wherever we wish to spend that money, we can spend it immediately, right? So here this interest becomes the opportunity cost. This becomes the opportunity cost. So if this opportunity cost is high, the people will say, okay, we will deposit more and more money in the bank, right? They will have less of liquid money. Liquid money means which can be immediately spent. You want to go to the market to buy a motorcycle, right? If you have the liquid money of 1 lakh rupees, you go give the money and take the delivery, isn't it? But if it is in the bank, then you will go to the bank, take out cash. Sometimes the system might not be working, take out cash, then take the delivery and all those things, right? After that is the degree of financial innovation. Now, inversely related. Why it is inversely related, sir? Nowadays you have the UPI apps. Now, with the invention of the UPI apps, credit card, debit card, internet banking, do you need to hold money as cash? No, sir. Right? So your demand for money here means the demand of holding the money in the form of the cash or in the form of the liquid asset. So he says inversely related to money demand, that is the financial innovations like the internet banking, app-based transfers, UPI transfers, right? UPI transfer, ATMs, etc. reduce the need for holding the liquid money. So that means one thing is clear, when we are talking about the demand for money here, we are talking about the liquid cash money. Liquid cash money holding. Right? So this is what is the meaning of demand for money, right? Why we demand money, what are the various factors which are influencing our demand for money, right? So with this, the basics are covered. This is what I wish to do in this lecture. The basics are covered. Now from the next from the next lecture, we'll be moving on to the theories of the demand for money. Very, very important topic from the examination point of view, right? So see you guys in the next lecture. Till then, stay safe, stay healthy, keep studying, keep sharing. Thank you so much.